All right, Ripple XRP holders. So we have some breaking news with Jerome Powell delivering his speech today, talking about the Federal Reserve's 25 basis point interest rate hike. I'm going to play this clip from his speech. I'm also talking about the Federal Reserve's balance sheet sitting at $8.3 trillion and what their plan is. Also, what's going to happen with inflation, what's happening with the unemployment rate, the correlation between the unemployment rate and the effective federal funds rate in the past, how that's affecting the charts for crypto. We're talking about the Dow. If you guys watched my previous video where I talked about the Dow compared to what happened back in the 60s and 70s leading up to 1982. And then also we're discussing the Dow to gold ratio. And I'm comparing that on the chart and showing you guys what's about to happen next for gold that could lead to one of the biggest precious metal bull runs of all time. And then we're talking about the correlation between gold to the crypto market and what that means for you, what that means for your portfolio, and most importantly, how to prepare. So comment 777 if you're feeling blessed, comment 777 if you're feeling bullish. And if you're gonna become the first millionaire in your family tree, you know what to do. Confirm it by giving it a tap-a-roo to the subscribe button. Just tap it in, sink the putt. You're gonna do it for grandma. As always, we're beating Shooter McGavin and we're buying grandma's house back with crypto.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a quarter percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment.
And banking.
It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
Which basically means that they're just going to keep going up with the effective federal funds rate. And as of July 19, the Fed's asset stood at 8.3 million. So their securities, mortgage-backed securities, they're going to be offloading those. Now, they've been offloading them for a period of time. They actually had to add more to their balance sheet with the Silicon Valley bank collapse and the other bank collapses that took place, where they basically offset months worth of QT, quantitative tightening, and so ushering in QE. And so if they continue to raise rates up, that's going to put a chokehold on smaller banks that won't be able to get the funding and loans at the rates that they need, because if they keep going up 25 basis points, now it's not going to be as drastic as what they did before, right, with 75 basis points, but it's still raised nonetheless. And if we're looking at inflation rate sitting at 3%, for June, well, when July's come out, if it's less than 3%, they're going to keep going up 25 basis points, I believe, the next meeting. And we'll keep you guys posted on that for this. But at a 3% inflation and looking at the unemployment rate compared to the past, it's we have a long way to go in terms of the unemployment rate. Because when I look at the max, we're sitting at 3.6%. Now, this needs to come up, which would help inflation go down. Otherwise, the Fed needs to keep going up on their effective federal funds rate if they don't want inflation, or if they don't want the unemployment rate to spike up. You see this spike that happened here. Well, this happened April 2020 because of COVID, right? No one could work because of the business closures. And so we go through economic cycles and booms and busts, and also periods of low unemployment and periods of high unemployment. And so when we have low unemployment going to high unemployment, then low, then high, then low, then high, where are we right now? Well, we're at low. What's going to happen next? So I love to break things down in such a simple way to understand, where you don't need to look at all this advanced stuff. Just keep it so simple, where we are right now in terms of unemployment. We're at 3.7%. Where are we going to go next? We're going to go up. So unemployment is going to go up. There's going to be some sort of economic shock that is going to happen. It's bound to happen. It happens every season, right? Fall, winter, spring, summer. Winter comes every season. Now, some winters are longer than others. Some are shorter than others. For example, April to December, this was a quick winter of high unemployment because of the CARES Act that Donald Trump signed into law, which gave everyone stimulus checks that got this back down, to bring unemployment back down. And so something will cause this winter of unemployment to go up, which conversely, which would affect inflation. So they're going to keep raising the effective federal funds rate. Now, here's one thing that's interesting. Looking at 1981, back to 1967 to 1981. So if I were to zoom in for you guys right here, we'll just go 1983, 1968, and we'll look at the unemployment rate compared to the effective federal funds rate. So when the Fed was raising what Jerome Powell just talked about, this rate determines how expensive it is for banks to borrow money from each other, and it affects all other markets of loans and all that stuff. When the rate's higher, it's more expensive, obviously. So the federal funds rate peaked out at 9.19 in August of 1969 before they lowered the rates and kind of paused for a little bit and then dropped them drastically back down to 3.7%. So what happened August of 1969? Well, when they peaked out in the labor market. Well, August of 1969, right here, if I were to look, the unemployment rate was at 3.5%. So when the Fed's effective federal funds rate peaked, then they paused for a little bit, lowered a little bit. Well, unemployment stayed low. Once they started dropping, then unemployment went up. So the Fed, what's going to happen here, now I could be wrong, but based on the past, because I like to look at the past, and this has happened, this is exactly what happened. I'll show you the next point to look at here, and then I'll give you my prediction for this. But December of 1970, unemployment went to 6.1%. So December of 1970, what was the Fed doing right there? Well, December of 1970 right here, they had already started dropping. They started dropping the rate in February of 1970. So that year, at the beginning of the year, by the end of the year, they were already down to 4.9% on the effective federal funds rate. And then by February of 1981, they bottomed out at 3.72%. This little rally, 5.5%, and bring it back down to 3.3% by February of 1972. Now, here's one thing that's interesting. The next point that they started raising from February of 1972 all the way up to July of 1974 when it peaked out at 12.92%. So July of 1974, let's see how that affected the unemployment rate. July of 1974, right, it peaked out on the effective federal funds rate. Well, the unemployment rate just started to trend upwards. It just started to tick upwards while they were raising them up, right? So the unemployment rate is a lagging indicator to the effective federal funds rate based on the past so far from what we see right here. Now, that doesn't mean that this is going to happen where we're at right now, but this gives us a good idea of what could happen here. And this is not financial advice, obviously. It's just education, and I love to look at charts of the past to show you guys this. So it took until May of 1975 before unemployment went to 9%. And so May of 1975, where were we here? Well, May of 1975, March, April, May, they had already dropped the rate down to 5.2% from 12.9%. So the Fed affects the effective federal funds rate, right? They pause up at the top. This wasn't even a pause. They just peaked out and then started dropping right away. So they didn't even hold the line. But once they started dropping, then unemployment spiked. Now, the next point for unemployment right here at 10.8% was November of 1982. November of 1982, what happened with the Fed right there? Well, the Fed had already started raising the rate up by 1980. 2 years prior, the Fed had peaked it out at 17.6. They dropped it really quick to 9, raised it back up. This was a massive volatile period, right? To go from 17.6% down to 9.03% is a pretty drastic drop. But by 1982, the Fed had already peaked out in June of 1981. And then by 1982, they had already started dropping the rate, right? If I click on max, they'd already started dropping it by November, January, May, and then October of 1982, all the way to 1983. It was already down by February of 1983 to 8.51%. And so, this peaked after that of November to December of 1982. So we go back to December of 1982. We were all the way down here. Right? December of 1982 was 8.95%. So what the Fed does to the federal funds rate, it lags into unemployment. So now if I were to click max, well, we are so low right now that my prediction here is when the Fed pauses on this rate and it peaks out for a little bit, and then they start dropping the rate on the other side, then that lagging indicator is going to go into the unemployment rate, and we're going to see unemployment spike up, and there's going to be some sort of, maybe a pandemic. I don't know if it'll be as intense as what happened in COVID, but it could have something to do with China, trade restrictions, something happening with some new epidemic coming that Bill Gates is planning. You guys let me know your thoughts there. There's news breaking about that and what he's planning for that. I can't confirm or deny it, so I'm not going to spread rumors, but I think you guys get the gist of what we're talking about here. So XRP, on the XRP price chart, sitting at 71 cents. Well, how will this affect XRP? Because we need to take a macro look other than just giving some crystal ball predictions on where the price could go for XRP, and the stock market, looking at the stock market as well too on the Dow Jones Industrial Average, because if we look all the way back from 1996 until 1968 for that 2-year period when the Dow dropped over 20%, then retraced back up to the 786. It got rejected from the 786, dropped down one more time, and then pushed almost up to the all-time high before getting destroyed and dropping 40% from right there for an ABC corrective wave. Now, if you watch my previous video, I talked about that. A wave was right here. The B recovery wave was up to the all-time high, and then the C wave was all the way down here for this, because the Dow had been on a massive rally prior to massive bull run, followed by years, like 16 years of sideways trading action volatility. So with the Fed just starting to raise the effective federal funds rate up again, and then they're going to be pausing, dropping, raising, pausing, dropping, raising, I could expect something like this to happen over the next 10 to 20 years for the stock market. So I'm not going to touch the stock market for virtually the rest of my life. And that's why I'm more bullish on blockchain, artificial intelligence, building businesses than ever before, because I feel like something like this could take place. Now, I do think in the short term, the Dow is going to push a little bit higher. I do think it could push up to the all-time high. I do think it could push up a little bit further, but I'm more bullish on precious metals than anything, and here's why. Okay, it's called the Dow to gold ratio. This is a 100-year historical chart. I've talked about this in previous videos, and to put it simply for you, if we look anything below 5 is a good time to sell gold and get in the stock market. Anything above 15 is a good time to get out of the stock market and get into gold and precious metals as a store of value. And I'm going to show you what central banks of other countries are doing too, because I don't look at, like I said, what influencers are talking about or what influencers are doing on social media. I look at what central banks are doing. I look at what the Federal Reserve is doing. I look at what China's central bank. I look at what Europe's central bank. I look at what Russia's central bank. What are these central banks that control the vast majority of what their country's financial systems look like? What do they do? And whatever they're doing will give you an indicator of what's going to happen moving forward. So what we're looking at right here is the Dow to gold ratio on the bottom of the chart right here on gold compared to the Dow Jones Industrial Average on the left. Now, if I were to minimize my zesty mug right here on the camera, where are we right now? We're at 18. And so at 18, being above 16, what does that mean? Well, that means it's a good time historically to get out of the Dow and into gold. Now, to show you based on the past, just to prove my point here, if we go all the way back to 1980 on the Dow Jones Industrial Average on the left, you guys saw how much time it took to go from the all-time high before it really passed that again decisively, and it took until 1982, so for 16 years. Now this vertical yellow line that you could see right here, where were we on the Dow to gold ratio? Where we were below 5, we were at 1. We were all the way down. If you're looking on the left-hand side of the screen, we were all the way down here at 1. So anything below 5 is a good time to get out of gold and get into the stock market based on this indicator, Dow to gold ratio. It's a 100-year historical chart. And so where was gold at? Gold was exactly pretty much at an all-time high. Right, give or take a few days, at $880, almost $1,000, right? So gold was all the way up here. So did it make sense to buy gold at an all-time high up here when the Dow to gold ratio was around a 1? This was the best time to short gold, to sell gold. And ultimately, it was the best time to get in the stock market. Shortly after that, not to the exact T, right? Because you guys can see the Dow was at about 900 and it dropped to 720. So shortly after that, the Dow did correct down another 20%. But even if you bought the Dow in February of 1980, and then by March, the next month, it was down 20%. Well, if you would have just waited and held for a few years while gold was crashing, so if you bought gold when it was at the peak, right? So if you look all the way up here, in 1966, it was at 28 at the peak. Well, that's a good time to get out of the stock market and into gold. You would have been buying gold at like $20 or $30 an ounce, and you would have been able to sell gold when it dropped all the way down to 1 at $800 an ounce. That would be a pretty nice profit, right? So we can just base things on this. And so this is why I'm more bullish on precious metals than ever before. So where are we right now? Well, after this, the Dow rallied from 750 all the way up to about 11,500, massive. So what percentage gain would you have gotten if you would have held your money in the Dow? I mean, compared to the DXY, you would have gotten over a 14x in the Dow from that period to 1999. So yeah, it's 20 years, and obviously there's bigger gains in the crypto market. That's why I'm more bullish on crypto. And I'm gonna talk about the correlation between these two. But if you would have bought gold at $800 when everyone was getting in the markets, you would have had to wait from 1980 before it passed the all-time high again. You would have had to wait until 2007 for 27 years before you broke even. 27 years, that's a long time, right? Now, when we look at gold right here on the Dow to gold, it was at 44 in 1999. What was the price of gold? It was $250 per ounce. So that would have been a great time to get into gold right here, and that would have been a great time to sell the Dow right here, because it took the Dow from 11,845 before it even passed that. It took until 2007, so it took about 8 years before it passed that, and it crashed for the 2008 2009 subprime mortgage crash, and then before it even saw any gains from there, it was until 2013. So 14 years. So macro, we're thinking decades, we're not thinking days here, all right? So when you look at XRP, the reason why I talk about this other stuff is because if you have a diversified portfolio and you develop skills that will generate you income on the front end, then you can know where to position yourself in the long term and how to seize opportunity when it arises. And so on the right-hand side of the screen, what we're looking at right now, we are above 15. Now remember, anything above 15, the higher up you go, the better opportunity it is to get out of stocks and into gold. And then the lower, below 5 we go, the better opportunity you have to get out of gold and into stocks. So for example, right here, I mean, we weren't all the way at 5, but we were at 5 or 6 on the chart right here, and when gold was at $1,900 per ounce. And so you could have made the argument the other way, where we're not below 5, we're in the middle, so I'm just going to hold. And sure, if you would have held, from 2011, you'd be at about almost you'd be pretty much at a break even right now, a little bit in profit, because gold is like $1,929 per ounce. Right now it's $1,972. Big whoop. It would have been smarter to get into Bitcoin when gold was at a high. So the money coming out of gold, right, from 2011 going into crypto, well, that's where the correlation between crypto wasn't really there. So as you saw gold, 2011, right, this green chart coming out of gold, that's when Bitcoin went from $3 all the way up to $1,000. Okay, so $1 or $2. That's when Bitcoin started. And so as gold was selling off, Bitcoin was peaking out. Gold was still selling off. I mean, Bitcoin kind of followed gold from the bear market rally of 2013 all the way down to 2015. But ultimately, when Bitcoin really started to rally upwards of 2017, gold wasn't doing too much. Gold just kind of traded sideways, didn't really pass the all-time high, whereas Bitcoin was ripping. It wasn't until December of 2018 when the bottom was in for Bitcoin, then when Bitcoin started to rally, gold started to rally as well too. Now, gold peaked out before Bitcoin in August of 2020, then Bitcoin peaked out in November of 2021. Gold had a little rally after that, and currently where we are right now is gold is about to pass its all-time high. Bitcoin is still relatively low compared to its all-time high, and then I'll talk about the correlation between these two. But if we look at gold on the right-hand side of the screen in comparison to where we were from November of 2015, the chart has some similarities that I could see right now if I trace it up to this, where gold could go on the biggest bull run of all time very, very soon, depending on the meeting next month and the meetings after that for the BRICS nations. Now, the meeting next month, they're not going to be talking about their precious metal backed or commodity backed or digital currency, the digital yuan that they have at part of their BRICS currency. They're keeping that on the hush hush, but my gut and my instinct is telling me that gold is going to be a big part of that. And the reason why is because of this. Look at China's gold reserves right here. This is China's central bank, okay? What they're doing. What is China accumulating? They're accumulating more gold than ever before. This tells me everything that I need to know right here, and this is a fact, okay? It's not a theory. This is what they're doing. Why would they be accumulating gold if they weren't bullish on it? Doesn't make any sense. So let's use really simple logic here. If a central bank is buying something up, what do they think is going to happen in the future for that something they are buying up? It's going to go up. It's going to go up. No guarantees. I could be wrong, but that's what China is doing. So that's not what I'm saying. That's just what China is doing, okay? So gold, I believe, is going to go upwards of $3,000 to $5,000 per ounce. Now, that's why I'm more bullish on gold and silver. I'm accumulating silver, but this chart right here, right, this fake out, as you guys can see, ascending triangle pattern happened from 2016, where we just saw a relatively flat horizontal resistance that it struggled to break out from, and we saw higher lows. Usually on these types of patterns, this is where fake outs take place, where we see a sell-off to the downside to liquidate the people that are long in the market and getting ready for something like this to take place. So there needs to be a liquidation event to liquidate people out, where we see a sell down below the 200 moving average right here, and then we see a retest of the upward trending resistance, which was support back in December of 2016 right here, and getting rejected from it, then going on the bull run right there. And so for gold, what did we see? Well, we saw gold formed an all-time high in August of 2020, created this resistance right here on March of 2022, retested the resistance again just recently. And so we see the exact same pattern happening. We see higher lows take place. We saw a break to the downside, liquidation of longs, and trading down below the 200 moving average for a short period of time, coming back up to retest the previous high, which you guys can see right here on the right-hand side of the screen, and it's currently selling below it right now. So are we experiencing something right here? Are we experiencing the same thing? Could we see gold come down a little bit further in the short term? Absolutely. I think gold could come down all the way back to the 200 moving average in red, coinciding with what I talked about in my previous video, where I could expect Bitcoin to see a sell-off back down to the 200 moving average in the short term, and then rebounding out of here and going into a massive bull run. Because when the Fed pivots and they start changing the effective federal funds policy and the effective federal funds rate, well, how does the effective federal funds rate right here affect the price of gold? Well, if we look back, let's just look right here, March of 1977, right before they started raising it from 4.69% all the way upwards of almost 20. So March of 1977 on the chart, we were right here for gold. Gold was roughly around $150 per ounce. Now, when the Federal Reserve started drastically increasing the effective federal funds rate, gold went from $150 per ounce to over $800 per ounce. So when the Fed starts raising the effective federal funds rate in the past, that caused gold to see a massive spike. Now, obviously that doesn't mean it's guaranteed for the future, but the chart pattern, very, very similar, showing some similarities here. And so I would expect gold to go absolutely insane. Now, how high could gold go if we were to draw the fibs from, the previous high of September 11 and we go all the way down to the low of 2015? Well, a full extension for gold would be $4,800 per ounce. So I think $4,800 to $5,000 per ounce as a full extension would be happening over the next decade. Now, I'm bullish on precious metals. I'm also bullish on crypto. Now, the correlation between, Bitcoin, crypto, XRP, the stock market, and gold, according to the 90-day correlation coefficient, Bitcoin is positively correlated to gold at 0.58% and negatively correlated to tech stocks. For most of this year, so you can see investors are more bullish on crypto and precious metals than they are on tech stocks. For most of this year, Bitcoin has been highly correlated to both assets. At the beginning of the year, the correlation to gold was deeply negative though, while the correlation to tech stocks was just below neutral. So then which is it, right? Because if it depends on the time of the year, it depends on the market conditions, because safe haven correlation or risk asset correlation. Or does the presence of multiple correlations point to no correlation at all? Does similar price action on a yearly basis constitute a significant relationship between two assets in the first place, or is it seasonal? So on a long enough timeline, everything breaks down. Over the past 14 years, Bitcoin has risen against the US dollar by tens of millions of percentage points. Few asset classes can boast similar returns. So other assets don't carry the same degree of volatility either, because volatility is the price that you pay for significant gains. You have to pay the price of volatility for these gains. You have to see Bitcoin drop by 80 to 90% plus in bear markets, and altcoins get even more wrecked to get the 10,000%, 20,000%, 30,000% gains, making long-standing correlation even less likely because of volatility. Now, to date, gold has risen from $800 in early 2009 to $1,945 today, and even higher today, all right, a gain of almost 150%. Nothing to sneeze at, but it's better than the dollar, that's for sure. And the NASDAQ is up more than 10x since early 2009 with returns in excess of 1,000%. While these are not insignificant gains, they are far cry away from the 52 million percent, not just 1,000%, 52 million percent the Bitcoin return from July of 2010 to, the all-time high. So in summary, the key takeaways here for correlation is as an asset that rises by more than 50 million percent over the course of its lifetime might not be correlated to anything else because it is a outlier. It's a complete black sheep asset class. You can't compare it to anything because there's nothing that can come in the same ballpark. So the correlation between Bitcoin, gold, and tech stocks often can't be seen on timeframes in excess of a year or two because crypto hasn't been around for that long, right? So you can't compare something for longer than it's been around for because it's impossible. So due in large part to the previous 2 points, the correlations don't hold much significance and they don't even matter. What matters here is what are central banks doing? What are they buying? How can you get out of the dollar and into productive assets? How you can develop skills to make money? Because if we look up the DXY right here, it is obvious that the dollar is going down in value. Even if the dollar sees a little bit of a rally, if I go to the day candles here, I talked about this, how the dollar could see a rally to this descending resistance line right here from, March of 2023. We see May of 2023. So the dollar could come up to this and then get rejected from it. So if I were to turn on the moving average, the 50 moving average and the 200 moving average, and then the 4-year moving average, what I would expect to happen is the 200 moving average to come intersect with the 50 moving average roughly around the same time that the DXY could come up a little bit higher as Bitcoin sees a sell-off down to Bitcoin's 200 moving average. Gold sees a sell-off down to gold's 200 moving average right here. And then what will happen with the dollar when the dollar peaks out during its rally, if it does, I could be completely wrong here. Again, the dollar could just keep going down and crypto could go up, right? But at some point, I do feel that something like this will take place when the dollar gets rejected and we see money flow into precious metals, gold, silver. It could push the Dow and the stock market higher as well too. Then we're going to see crypto go on a bull run this year. Then when the Fed pivots, it's going to be very interesting to see how that's going to affect the markets because historically it would cause some crazy type of, based on the past, what happened in the 1960s for the stock market, the Dow could get obliterated for a C wave all the way back down to levels, around where COVID was or even pre-COVID, like I talked about in my last video. By then, I'm going to be accumulating as much dry powder as possible. I'm going to be backing the truck up as much as possible, grabbing the bags, packing them and stacking them, leaving no bags left behind because the spending power of the dollar is going down in value. That's a fact. Crypto, precious metals, productive assets, blockchain technology, artificial intelligence,